A massive earnings beat that looks absolutely flawless right up until the CFO quietly admits they borrowed half of it from the future.
That's a bold thing to just volunteer on a public call.
Totally. Welcome to Earnings Unscripted. We're looking at ServiceNow today, ticker NOW, for their second quarter. It's July 22nd, 2026, and they're definitely making things complicated.
Very complicated.
So the top line looked incredibly strong. They posted roughly $4 billion in total revenue, up 24% year over year. They comfortably beat the street on earnings too. But the stock didn't pop. It just chopped around after hours and finished modestly lower.
Well, because the market actually read the transcript. Management came right out and admitted roughly half of their bottom line beat came from U.S. federal on-premise contracts. They pulled a ton of government demand out of the third quarter and closed it early.
Okay, wait, say that again, but slower. So they convinced the government to sign a few months early, and they stuffed that revenue into this current quarter?
Exactly, which completely pads today's numbers.
Right, but doesn't that just create a giant revenue hole they have to fill next quarter?
It does. Those third quarter sequential comps will look artificially weak because of it. And honestly, since I'm going to be fairly cynical today, please remember I don't hold a fiduciary license, so definitely treat my grumbling as pure opinion rather than investment instruction. But look, optical distortions aside, the actual organic demand they're seeing isn't fake. Their new AI product officially crossed $1 billion in annual contract value.
Wow, $1 billion already? That's wild. But what threw me off wasn't the AI milestone, it's their balance sheet. They're practically a completely different company today.
You mean the debt explosion from buying Armis?
Yes, they spent billions buying into cybersecurity, and total debt just absolutely surged to over $7.5 billion.
Yeah, going from practically no short-term debt to suddenly managing a massive new term loan rewires their entire capital structure. They aren't just a simple workflow tool anymore.
No, they're absorbing thousands of security engineers now. Which brings up the weirdest thing they claimed on the call, and I really need to know if you think they can actually pull off that zero-growth headcount promise.
It's mathematically brutal. If you acquire 3 massive, highly technical teams like they just did, someone else has to go to make the math work. The CEO, Bill McDermott, explicitly said on the call, "We will complete this cycle of 2026 and start 2027 with the exact same headcount before we did the acquisitions."
Okay, wait, walk me through that. They just absorbed thousands of people. Are they just laying off the founders and teams they just bought? That makes no sense.
No, you definitely don't fire the specialized cybersecurity talent you just paid billions to get. You keep those new forward-deployed engineers, and you shrink your legacy workforce. They're basically using their own autonomous AI to replace their internal operational support staff, so they can fund the expensive M&A payroll with the savings.
Wow, I mean, it's pretty ruthless to eat your own dog food like that, but I guess it proves their product actually works.
Right. And it bleeds into the most fascinating part of their whole strategy right now. They're explicitly attacking the hyperscaler business model. They've completely rejected the idea of charging per token.
Charging per token, like how you pay a tiny fraction of a cent every time an AI generates a paragraph?
Yeah, exactly, which creates totally unpredictable costs for buyers. The CFO, Gina Mastantonio, had this brutal line. She said, in an environment where most enterprises are still searching for AI's ROI, ServiceNow is the platform delivering it. Customers aren't paying us for tokens, they're paying for resolutions.
Oh, I love that framing, because everybody's getting ROI fatigue from paying this constant, unpredictable tax just to run queries, regardless of whether it actually fixes the customer's problem.
Exactly. So they're selling certainty. They're pushing what they call agentic AI. It doesn't just draft an email, it actually takes action and closes the ticket end to end. There was this wild anecdote about the city of Raleigh.
Okay, I'm intrigued.
A local government deployed ServiceNow's Level 1 AI specialist, and it works entirely autonomously, 0 human engineers backing it up in the workflow. It just clears municipal service tickets by itself, one category at a time.
Completely autonomously? In government? You usually need a committee and 3 stamps just to complain about a pothole.
I know, it's wild, but they did it. And a major airline just migrated all their customer service voice channels to ServiceNow's voice AI. The system orchestrated over 5 million spoken phone calls in a single year, basically with no human operators.
Geez, 5 million calls. That's a staggering amount of human labor just wiped off the board.
It's a massive offset, but here's the messy part. As all these giant enterprises start spinning up these bots across different departments, it's turning into a complete governance nightmare. Rogue bots are everywhere. That's why ServiceNow built their AI control tower.
Right, the control tower. So wait, is that basically just a financial dashboard to track how much you're spending across all these random bots?
No, it's much sharper than that. It gives IT a literal kill switch. A food and beverage company found these undocumented AI bots proliferating across 5 separate internal systems. They used the control tower to hunt them down in real time and just instantly terminate their access to the company data logic.
That sounds like a sci-fi horror movie. A corporate kill switch for rogue AI bots in the beverage department.
It sounds crazy, but it's the new reality, which is why McDermott was pitching that the enterprise needs one governed layer of record for work, no matter which AI lab wins the foundational model race.
It makes you wonder if they're pushing too hard too fast, though, especially since they're heavily delaying their marketing spend right now just to protect those pristine margins.
That's exactly the vulnerability. They intentionally pushed marketing spend into the back half of the year, which helped pad the operating margin we talked about earlier. But if you starve marketing today, you risk choking pipeline velocity tomorrow.
Right. I mean, you can't just pause the top of the funnel without feeling it eventually. So did they actually temper their expectations for the rest of the year, or are they just powering through?
Oh, they're powering through. Management actually raised full-year subscription revenue guidance to a midpoint around $15.77 billion. They're also targeting operating margins at roughly 31.5%. Gina Mastantuono basically said on the call, "This is simply about timing. I am very confident in our Q3 and full-year guide."
Okay, but we've got to remember the trap they set for themselves with that federal pull forward. Next quarter, their sequential growth is going to look artificially slow just because they already banked those chunky government deals in Q2.
Exactly. The real question is whether that optical dip ends up hiding any actual demand softness. But McDermott is leaning hard into cost efficiency. He had this great quote, "People are realizing you don't need to take a Ferrari to mail a letter." He's betting enterprises will consolidate onto their system to save cash rather than paying hyperscalers for basic AI tasks.
Love the Ferrari line because it's so true. Companies bought all this shiny generative AI hype, and now they just need a tool that actually closes a support ticket.
Yeah, reality always catches up to the hype cycle. The last structural piece to watch is their commitment to shareholders. They formally pledged to bring stock-based compensation down below 10% of revenue by 2029.
Which is massive promise, especially while trying to absorb 3 security acquisitions with flat headcount. All right, they've got a lot of moving parts to manage, and next quarter's distorted optics will definitely test Wall Street's patience.
Should be an interesting one. Catch you later.
If you enjoyed the chat, feel free to add us to your podcast rotation. And speaking of autonomous agents taking over workflows, this entire show, voices included, is completely AI generated, going straight from the filings to your feed the same day. We love your thoughts, so drop any feedback or ticker requests to earningsunscripted@datamadness.ca. And have a great week.
Catch you on the next one.